Secretary of the branch, C.G. Vasudevamurthy, Managing Committee, senior members of the profession, past chairmen of the branch, our beloved Center Council member, C.A. D. Prasanna Kumar, today's chief guest, and C.A. Mahendra Sanghvi, a renowned speaker from Mumbai. A very good evening to one and all. I welcome you all for today's virtual CP seminar on amendments for the assessment year in the Finance Act for the year 2021 and presumptive taxation. Presumptive taxation for business is covered under section 44 AD of the Income Tax Act. Any business which has a turnover of less than 2 crores can opt to be taxed under presumptively. They must declare profits of 8% or 6% of if digital transactions, whichever is applicable. For opting of 8% or 6% or whatever to go for tax audit, the initiatives involved and the benefits or procedures to be followed if the presumptive taxation is opted. Today we have with us a very renowned speaker to deliberate on this topic, and we are fortunate to have his acceptance to address our Visakhapatnam members through virtual mode. Members today, C.A. D. Prasanna Kumar, chief guest, is going to address on few of the issues being at the helm of the affairs, what the decisions have been taken care, and regarding the MEF also, as members have been worried of MEF, as September has already, it is mid of the September, still the MEF notification has not yet released. So sir will deliberate on all the issues at the end of the session. I request C.A. Prashant, Treasurer, to introduce the speaker and the chief guest.
No introduction for me again. It's embarrassing. Don't introduce. I'm here again. Please go ahead. Please go ahead.
Well, as such, Mr. Prasanna, I am also not very new for this August gathering.
100% you are right, sir. You are right. I had to join with you.
Respected Chairman, respected CCM and Speaker and all other members, good evening. C.A. Mahendra Sanghvi, practicing chartered accountant from Mumbai. He is a partner in the firm Sanghvi and Sanghvi. He is a practicing in income tax matters and audits. He is a past president of Chamber of Tax Consultant. He currently chairman of Law and Representation Committee of Chamber of Tax Consultants. He was nominated as a member of the Regional Direct Tax Advisory Committee by CBDT. He was member of Standing Committee on TDS for Mumbai, Region Commissioners of Income Tax, TDS. He gave lectures in meetings organized by Chamber of Tax Consultants, Bombay Chartered Accountant Society, Institute of Chartered Accountants, and other organizations. He written articles in newspapers and magazines of professional interest. He contributed of reference manual of WIRC of ICAI. He given lecture during the training sessions of public sector companies and orientation and training programs of the tribunal matters. With these few lines, I'm happy to introduce C.A. Mahendra Sanghvi to the August gathering. Thank you very much, and hand over the proceedings to the chairman.
Sir, I request beloved Central Council member to speak at a few words, and then I'll hand over the proceedings to the speaker.
Okay. C.A. Bharti Devi, Chairman of Visakhapatnam branch of SASF C.A. Murali Krishna, the Vice Chairman. C.A. Vasudevamurthy, the Secretary. I think I am able to see him just now. He joined. C.A. Prashant Kumar Panda, the Treasurer. C.A. Vice Surichandra, the member of the committee. C.A. Ramaprasad, the member of the committee. C.A. Chalapati Rao, the immediate past chairman of Visakhapatnam branch. And respected C.A. Mahendra Sanghvi, the speaker on today's session. And my dear colleagues, ladies and gentlemen, good evening to all of you. It is once again a proud pleasure for me to join for a program organized by Visakhapatnam branch. As all of you know, Visakhapatnam branch is very dynamic, and they have been, in spite of the pandemic, they have been organizing programs on a variety of topics, very time and again. They made a very good beginning. It has took off very well in this pandemic situation also. I compliment the entire managing committee. Of course, I am also part of the managing committee. I'm only supporting them. So it's no one them, but they are the people in the front running the entire show. So today's topic is well chosen. The presumptive taxation is one of the important topics in the entire taxation today. Because if you take the number of assessees who have got the turnover up to 2 crores of rupees, those are coming under the income from business or profession, I think the maximum number of the assessees fall in this particular bracket only. And this was the presumptive taxation one which was started long ago, maybe more than 2 decades. We aiming at only the contractors, because that was supposed to be unorganized business entity. Business was contractors. It was introduced like that from 44 AD. Later on, it has been extended to many spheres, including professionals, so on and so forth. Now, today has become one of the important aspects. If you have to have a session on presumptive taxation, I think even one day a session of 6 hours also is not enough, because so many sections have come and the presumptive taxation. However, today we have a very great speaker in Mahendra Sanghvi. He's a renowned person in the taxation. As you know, like the Institute of Chartered of India, there are 2 other renowned organizations. So though they are not mandated by the statute, one is the BCAS, Bombay Chartered Accountants Society, other is the Chamber of Tax Consultants. Both are in Mumbai. They are renowned organizations because from there on we are getting the very good speakers in the country. They are the people who mold speakers, and they are the speakers today, renowned speakers across the country. In that scenario, our Mahendra Sanghvi is also from the Chamber of Tax Consultants. He was the helm of the affairs. Even today, he's hand-holding with the CTC. That's why such a renowned speaker coming to Visakhapatnam to share his knowledge is the most welcome measure. Even I know some of the youngsters I have seen in Visakhapatnam also, if there is a program of CTC, now because of the pandemic they are not going. Otherwise, whenever there is a program of CTC in Mumbai, they go to Mumbai. So they stay 3-4 days, enjoy all the sessions, come back. That is the level of CTC. So I welcome you to Visakhapatnam. Though you are not new to all of us, most of the Visakhapatnam people know you. It's a homecoming for you always. So welcome you. Let's have a great deliberations today. All of us will be benefited through the deliberations. Anyway, I'll be joining at the end of the session. Let us indeed the knowledge through Sanghvi. The end of the session, just to share some thoughts, because some few calls have been coming to the chairman as well as me. I'd like to clarify some 3-4 points to stress upon. With these few words, thank you very much. I'll join you again at the end of the session. Thank you.
Thank you, sir. I request the speaker to take over the session.
Yeah. Good evening, everybody. Chairperson Bharti ji, today's chief guest, Central Council member Mr. Prasanna, and Mr. Parsnath, who has spoken a kind words for me, and Mr. Vasudeva Murthy, the secretary, and other senior friends present over here, and the rest of the council members, managing committee members. I must even acknowledge Mr. past chairman, Mr. Kumar, who when I was there, who have been with me during my visits to for the earlier topics. Friends, first of all, thank you very much, Mr. Prasanna, for your very kind words and for the kind words of the association also. It's always been a pleasure to express the views and to share the knowledge, what we have gained from our seniors and from our colleagues. Nevertheless, I must even acknowledge that while visits to Visakhapatnam, it has always been very homely and comfort earlier whenever I have visited. Friends, the topic today selected, as such, it has 2 springs. One is the amendment related to assessment year 2021, and we shall be covering more so which are required for filing of our return of income, preparation of our computation of income. At this stage, let me confess that yes, I am not at all good in the ITRs, that is ITR 1 to 7, what we have, what are the technical problems if we have on that. I'm not good in that. Nevertheless, when the question answer is there, I shall try to invite the questions so that maybe the answers I don't have, but at least the questions are highlighted, and the answers, if any of your persons are having the reply to that, it will be helpful to those persons who has raised the queries and to all others in general. Normally, friends, the amendments when we are related to assessment year 2021, then we immediately start referring to the Finance Act 2019. And also for some relevance whether it has in the Finance Act to 2020. But normally these are very few, if at all, then they are treated as whether they are retrospective, whether they are applicable for assessment year 2021 or not. But here you will see when we run through, certain major amendments have been carried out by way of Finance Act 2020, and those are applicable for assessment year 2021, and more so it has a very big impact when it is to be read along with the presumptive taxation for the purpose of 44AD. Now I will start sharing my slide show so that you can have the comfort of even benefit of the show over here, slide presentation. Okay. Is my this presentation visible, everybody? Is
Yes,
it okay?
sir. Visible. Yes, sir. Visible, sir.
All right. I'll just put it on a full screen so that there is some issue on the full screen. Okay, I think, yeah, now we can proceed. So first very slide is just, you can say, a little bit warming up. When I started, I thought let it be a little bit of warming up, but then I realized that no, that also is as important as the other slides are. We do not have any much changes as far as the tax rates, except for the companies. They have been unchanged as compared to the earlier year. But however, the surcharge, there has been a very big increase or a jump in case of super rich persons, and which has increased to 25% and 27% depending upon the total income of that SSE. That is 2 crore to 5 crore is 25%, and above 5 crores it is 37% for individuals and HUFs. This is the increase in the surcharge as far as the surcharge is concerned. However, for the levy of surcharge, where the total income includes any income chargeable under section 111A and under section 112A, that is on capital gains, the rate of surcharge on the amount of income tax computed on that part of income, that is that particular capital gains, shall not exceed 15%. And the rate of MAT is reduced from 18.5% to 15%. There has been another amendment which is not on account of the Finance Act. However, it is on account of 9th Amendment Rules 2019, and wherein it talks about the rates of depreciation, which has changed in case of motor car other than those used for business of hiring, which is acquired on or after 23rd of August 2019, and which is put to use before 1st April 2020, and the rate of depreciation in such case, so for such motor car, it will be 30%. However, if the motor car, buses or the vehicle is used in a business of running them on hire, and if it is acquired after 23rd of August 19 and put to use before 1/4/2020, in that case, the depreciation will be allowed at the rate of 45%. So this is one change. So at the time of preparing your computation and your audit, one needs to take care of this change. So this will be a separate block of asset now, and which will carry on for further few more years till this block is there. And the depreciation also henceforth will also continue at the rate of 30% and 45% respectively. It does not restore back to, it's not only for 1 year benefit that they have given. Certain small amendments as far as section 9 is concerned, which is on income deemed to accrue or arise in India. They have widened the scope by clause number 8, and which is inserted with effect from 5/7/19, and which is qua section 56 to 10, which is now going to be applicable to a non-resident also. So if a gift or a property is given to a non-resident, this will be treated as a deemed income of a non-resident. Another is on section 10(12)(a), wherein we all are aware that in case of National Pension Scheme Trust, the exemption of withdrawal and the closure or at the time of closure of account, which was 40% for this assessment year 2021, it has been increased to 60%. And standard deduction on salary, which was 40,000, has been increased to 50,000 for the assessment, relevant assessment year. Wherever I have any other specific assessment year to mention, if I do not mention, then it has to be understood during the course of my talk that it is for assessment year 2021. In from house property. Friends, on this house property, you all are aware that up to assessment year 1920, if an assessee had more than one house for his self-occupied, then one house was allowed as self-occupied property, and on the balance house, you were required to calculate deemed let out income and the annual value of that. Accordingly, the computation was required to be done. Now, for that, from the one house property, they have increased it to two self-occupied house property. So a person having two self-occupied house property, he did not have to calculate any deemed let out income. However, if it is more to on the balance of those, to calculate more deemed let out income. However, the maximum amount limit of the 2 lakh rupees can be claimed only to the extent of aggregating for both the house to the extent of 2 lakh rupees only. The another one is on section 23 subsection 5, wherein a builder developer who is holding the immobile properties as stock in trade. In that case, from assessment year 18-19, a proviso of deemed income was made applicable if there was a stock in trade and which was not deriving any income from that, that is, it was not let out. In that case, here also the concept of deemed let out was to be applied, and the deemed income was to be considered. However, this concession was available if the period up to 1 year from the end of the financial year in which the certificate of completion, we commonly call it as CC, of construction property was obtained. So for 1 year, this was allowed. From this assessment year 2021, the period of 1 year has been extended to 2 years. I am aware that this is a very harsh provision. There was too much of representations done by various owners, but somehow they have shown a little more. They have shown the sympathy, saying that okay, we are extending this provision from 1 year to 2 years, and by that we have still this provision on the statute. Our representation was that this should not at all be treated as a deemed income. This is a stock in trade. However, because of the decision of a High Court, Ansal Housing, wherein it was held that yes, it should be treated as a deemed income, and thereafter now in the statute we have this, that anything as a stock in trade, if you have, if after getting the certificate of completion, from the end of the year, 2 years you count, and thereafter still that remains as a stock in trade, you need to calculate your deemed income. The next one is on profits and gains. Section 43B is a provision wherein if certain items, which includes like bonus, statutory tax payments, interest to financial institutions, interest to bank, etc., etc., if the payment of the expenses are not made during the previous year or till the due date of filing the return of income, in that case, those payments will be allowed on payment basis. That is the year in which you make the payment, it will be allowed, and not the year in which you have created a provision. From this year, they have extended, or I would say they have included one more nature of interest, that is interest payable to non-banking financial companies, NBFCs. So along with the interest to the banks, now it is to the non-banking financial companies also. From this year, if any interest is not paid, and more so, we have to be very particular because of the COVID situation, the businesses, the cash flows have been disturbed a lot. Many places, many SSCs have not been able to make the payment or meet the statutory dates. So if till the due date, the payments are not made, then that will not be allowed, and the tax practitioners need to take proper precaution that and they are allowed only on the payment of on the payment basis. The next amendment I would like to touch upon is on 40A1. This is as far as the deduction, as far as the disallowable is concerned, for the taxes that you were required to deduct, that is withhold taxes, and if those taxes have not been deposited before the due date of the filing of the return, in that case, there was a disallowance called for. We already had a provision under section 40A1A wherein the payments to a resident was made, and the taxes required were not deducted as per the provisions of chapter 17B. In that case, the disallowance was there. However, by way of Finance Act 2012, a proviso, second proviso was inserted, and which said that if the SSC is not an SSC in default, as per the provisions of section 201, in that case, the taxes which were required to be deducted, if they are not deducted, still it will be presumed that the taxes have been deducted. Now, this proviso which was inserted by Finance Act 2018, they have now 2012. I'm sorry, they have now been even extended to the payment made for non-residents. Therefore, now, if in the case of non-resident also, where an SSC fails to deduct the whole or any part of tax in accordance with the provisions of Chapter 17B, on any sum, the SSC will not be deemed to be an SSC in default for the purpose of this subclause, and it shall be deemed that the SSC has deducted and paid the tax for the purpose of section 40A1A, and no disallowance is required to be made. That brings me to another source of income on capital gains. Section 54, which talks about that any profit on sale of property used for residence purpose, then there was a deduction. If the SSC has purchased or constructed a residential house, then there would not be any capital gains to the extent of the sales consideration if it was utilized. However, there were different views. The judicial pronouncements were also different from various high courts, wherein a residential house, whether it should be treated as one residential house or whether it should be treated means more than one residential house. We have various case laws to decide, which decided, some of them said more than one, some of them said no, is to be read as one residential house. However, from assessment year 2019-20, they have amended the law and the "a" word was replaced by one residential house. Now, from assessment year 2021, that one residential house has to be read as two residential house. So therefore, if a SSC who has made capital gains and if is investing in purchasing or constructing two residential houses, in that case, he will be eligible for, he will be allowed as a deduction. However, there is a condition attached to this, and which says that the amount of capital gain should not exceed 2 crore. So a person who has the capital, where the capital gain is more than 2 crore, this benefit is not of two residential house is not available to him. It is restricted only for the person who has got capital gain more than 2 crores. And the second condition that they have laid is that this option is available only once in the lifetime of the SSC. So once if you have opted, further you will not be able to take the benefit of these two residential houses under section 54. Two new sections have been inserted as far as the deductions under chapter 6A goes. And that says, first it talks about section, first it is on 80 EEA, and it provides that an individual for deduction in respect of interest on loan taken for acquisition of an affordable residential house property, if the interest payment is up to rupees 1,50,000, then he will be allowed this deduction under section 80 EEA. However, they have put up conditions, and which conditions are: one, loan is sanctioned from a financial institution during the financial year 1920, and the stamp duty value of the property should not exceed 45 lakhs. And third is the SSC does not own any residential house property on the date when the loan is sanctioned. There have been, I understand what do you mean by stamp duty value? It should not exceed 45 lakhs. So supposing if the agreement value is 50 lakhs, however, the stamp duty value is 45 lakhs, whether the SSC will qualify for this deduction or not. According to me, yes. Here the section has made a clear reference of only stamp duty value. Had there would been any ambiguity, then they would have used the word stamp duty value or the agreement value, whichever is higher. That not being the case, we understand that it is the stamp duty value only which is required to be considered. Second, you may have to consider that in case if the agreement value is 45 lakh or less than 45 lakhs and the stamp duty value is exceeding 45 lakhs, whether the SSC can take the benefit. Similarly, the same analogy extending, no, in that case, if the stamp duty value is only to be seen, then though for various provisions, section 50C, 43CA, section 56, we do have a marginal relief of 5% and thereafter 10%. But then for here, applying these provisions of 80 EEA, there is no such marginal relief benefit available. The next one is whether if the SSC who owns a residential house after the sanction of loan, he has two residential house, maybe by way of a gift he has received, and thereafter he acquires another residential house, whether he will get the benefit. The answer to this would be yes, because it talks about as on the date of sanction, he should not own more than one residential house. That one needs to be take care of this issue also.
Sir,
The
would you
next
like to take the questions in the middle or at the end of the session, sir?
I don't mind. I don't mind as far as if relevant section is there, definitely it should be taken at the middle so that the person who wants, he can get the answer immediately.
Okay, sir. A question has arisen regarding this only, the session what you are talking about. If the consideration is greater than the stamp duty values, stamp duty value may automatically increase. Your valuable views, please.
No, the stamp duty value would not automatically increase. The stamp duty value is the index value what we have. Different places have different values, different municipalities have different stamp offices have different values, and even if your agreement value increases, your stamp duty value only for the purpose of your stamp duty it increases. Your value as per the stamp office would remain the same. Ready reckoner rate would remain the same. Let us go to section 80 EEA, which provides which is also for only an individual if he has acquired loan for the purpose of purchase of electric vehicle and any interest payment on that to the extent of 1,50,000, then subject to the loan sanctioned by financial institution during the financial year 2019 to year ended 31st March 23, the SSC will be eligible for the payment of interest under section 80 EEB to the extent of 1,50,000. Here the provision of section 80 IBA, applicability to very limited persons. Nevertheless, it is saying that provides for deduction in respect of profits derived from business of developing and building affordable housing projects, subject to the project being approved by an affordable housing as an affordable housing project by the competent authority after 1st June 16, that after this finance bill was passed and made as an act, but on before 31st March 2019. And the person for getting the project approved from the competent authority now has been extended because there was already a sunset clause that has been extended by 1 more year, and which is up to, if the project is approved up to 31st of March 20, the SSC will be able to get the benefit of 80 IBA. This section 87A, which is on rebate, which is of course a very old section, doesn't require much discussion on this. Nevertheless, let me put it down that first of all, this section is applicable only to resident individuals. And secondly, I don't know why the government wants that every 2 years they want to tinker with this section. The limit up to 2,500, subject to the total income not exceeding 3,50,000, has been raised. Both the limits have been raised. Earlier, 2 years back, if you see, yes, already this limit was a higher limit. Thereafter, they changed. Now, again, from assessment year 2021, the quantum of rebate is increased up to 12,500 and subject to the total income not exceeding 5 lakh rupees. In case if the total income exceeds 5 lakh rupees, then the quantum of rebate will be nil. Now, on account of that, and on account of there being no marginal relief allowed to them, the situation would be if an SSC has an additional income of 10,000, say his income is 5,10,000, then the SSC would be landing up paying 15,080 rupees of tax. So for that additional 10,000 of income, he would be paying a tax of 15,080 rupees. That is an absurdity, but nevertheless, this is what the law provides.
A few more questions has arisen regarding property, sir.
Sure.
Sir, in case of purchase of old flat, the actual value is less than 40 lakhs. Will the benefit be denied? In case of purchase of old flat, the actual value, the municipal value is 50 lakhs, sir. Will the benefit be denied?
Yes, yes, yes. If the municipal value, if the index value or the stamp duty value is more than 45, though your agreement value, it being an old flat or whatever reason, still you will be denied the benefit under section 80 EEA.
Okay, sir. And one more question is,
Sure.
an SSC is having one flat and it is let out and getting rent. Is he allowed not to show the rental income stating that one self-occupied house is exempt?
Is it for the same, say, for taking the benefit of EEA?
No, sir. I don't think this
please,
is of
can you repeat the-
EEA, sir. This is a general house property, I think.
Can you repeat the question?
An SSC is having one flat and it is let out and getting rent. Is he allowed not to show the rental income stating that one self-occupied house is exempt?
Yeah. I understand. So it is connected to section 23 amendment, which has come by way of 23(4). So here, more than now, up to 2 houses, you do not have to calculate your deemed let out income. Actually, earlier it was, if you have up to 1 house was only allowed, anything more than 1 house, for all the house property, you were required to calculate your deemed house property income. Now that 1 house has been replaced by 2. So therefore, if you have more than 1 house, you need not calculate your deemed house, deemed let out income. So up to 2, there is no issue at all.
And is the deduction of 2 lakhs interest allowable to both joint owners each?
No. Joint owners, yes, definitely. Joint owners, both of them can take the benefit of the 2 lakh rupees.
Okay, sir, you may continue.
All right. Now, this is another one section which we all have to be careful on, and that is on the proviso that has been inserted to section 139(1). We all are aware about 139(1) because we have been filing our return of income regularly for our SSCs. 139(1) says, 139(1) has 2 categories of SSCs who are required to furnish the return of income by the due date. Category A, which comprises company and partnership firms, and category B, which is other than A, or say other than a company and a firm, if his income exceeds the amount not chargeable to tax. Therefore, for category B, if the income does not exceed the amount chargeable to tax, only, say for example, if it is an individual or an HUF, unless the income exceeds the income chargeable to tax, that is in our example, say if it is more than 2.5 or 2,50,000, then he is not required to file the return of income, subject to the provisos that we have under section 139(1). We already have 6 provisos. If any SSC is falling into any of the 6 provisos, he is still required to file the return of income, though whether his income is taxable or not. Now they have inserted one more proviso, that is the proviso 7, and which says, provided also that a person referred to in clause B, which I have already said, other than company or firm, and if his income exceeds amount not chargeable to tax. So other than those person also, he is required to furnish the return of income if, number 1, has deposited an amount or aggregate of the amounts exceeding 1 crore rupees in any of the current accounts, aggregating to all the current accounts that he have maintained with the banking company or a cooperative bank. So if during the year he has deposited more than 1 crore of rupees to all his current accounts maintained across in the bank, whether cooperative bank or any other bank, then he is mandatorily required to submit his return income. Whether his income is taxable or not is not a criteria. Similarly, the second one has incurred expenditure of an amount or aggregate of the amount exceeding 2 lakh rupees for himself or any other person for travel to a foreign country. So even if you have incurred for your family members, for your friend, your relatives, and if that amount in the financial year exceeds 2 lakh of rupees for a foreign travel, then also you are mandatorily required to file your return of income. And the third instance is he has incurred expenditure of an amount exceeding 1 lakh rupees towards his electricity expenses. Now here the issue would be, if an SSE who is a proprietor, does he have to consider his electricity payment for his factory, his office, his workplace, and his residential? Or if he has more than one residential, all his residential and his offices, all together, if he has incurred more than 1 lakh rupees, in that case, he will be mandatorily required to submit his return of income. And the fourth one, they have kept it very open to say that fulfill such other conditions as may be prescribed. So wherever the CBDT feels like that, look, now this condition also requires, say, if you have made an investment of above rupees 5 lakh in any of the financial institution or in any of your shares. So any conditions now they can put, and fortunately they have not prescribed any more condition for this year at least. But I won't be surprised if they have a list of other conditions for this proviso also. And further, if you see, this seventh proviso, which is applicable, they have accordingly made the amendment to ITRs 1, 2, 3, and 4. So whichever is applicable to, except for the partnership firms and to the companies and to the trust, they have already made an amendment to this on account of this proviso. And the amendment in your ITR reads something like this, which is an abstract. The question asked to you is, are you filing return of income under 7th proviso to 139(1), which otherwise you were not required to submit. But because of these 3 conditions, you are filing the return. If the answer to that you click is at yes, then further you need to answer 3 more questions, whether that is on account of the deposit of rupees 1 crore or more in current account. Then if you say yes, you need to give the amount of deposit that you have made in the financial year in all your current accounts. Similarly, for your foreign travel, if you say yes, then you need to give the amount of your foreign travel that you have incurred. And the third case, similarly for your electricity consumption of your electricity, if you say yes, then you need to give the amount over here. This is what is an abstract of the ITR that you require to address while submitting your income tax returns. That brings me to certain small amendments, which we just, for your, while preparing your computation for taking the TDS credits and all, you be a little careful. 194A, which is interest on interest other than securities, the threshold limit of 10,000 has been increased to 40,000, but only in case of interest payable by a bank or a cooperative bank or post office. Otherwise, the threshold limit of that 5,000 remains the same. For bank, which was 10,000, has been increased to 40,000. Even there is no change for the threshold limit for a senior citizen, which was 50,000, continues to be 15,000 as it was. And the basic threshold limit of that 5,000 to other than bank or cooperative bank and post office, that also continues as it is. There is no change in those accounts. Section 194I, the threshold limit of 1,80,000 has been increased to 2,40,000. So while auditing, if the taxes have not been deducted, you can always check whether the threshold, is it on account of the limit which has been increased, that no taxes have been deducted, it should be fine. Sorry. Yeah. Coming to 194IA. This is a consideration for transfer of any immovable property, which this was a section which has been introduced earlier in earlier years, but however there have been always a confusion, or I must say the interpretation problem as far as what do you mean by the word. Now by way of an explanation, they have made it very clear that your consideration of the property amount would also include payments towards club membership fee, car parking fee, electricity or water facility, by whatever other names you want to call, or of a similar nature. However, it would not include, because the words are any other charges of similar nature. Similar nature would not go to the extent to say that whether the transfer fees or the stamp duty or charges paid to the society are to be considered as a consideration for the purpose of invoking section 194IA. Other than those, any other payment made to either the made by purchaser to the seller or to the builder, in those cases, that all needs to be considered, because we had seen the agreements just merely for not falling into the provisions of IA. If the consideration was say 52 lakh rupees, then that 2 lakh would have been divided by way of either saying I am charging you for your car parking fee or your club membership fee or some other facilities that I am providing, and the consideration would come within 50 lakhs and no tax was required to be deducted. To plug that loophole, the amendment has been made and clarification has come. The next section is 194I. This is a new section which has been introduced for assessment year 2021, and which says that in case of individuals and HUFs who are not required to get their books of accounts audited, and if they are making the payment towards supply of labor, carrying out any work, or for commission, or for brokerage of professional fees, and if that exceeds rupees 50 lakhs during the financial year, are required to deduct tax at the rate of 5% on those payments. Now, let us understand this, whether these payments are to be read independently qua this 50 lakhs. Say if a person is giving a contract to an architect that you please carry out the work, and the total contract value of that interiors, including that furniture, would exceed 50 lakh of rupees. In that case, since the entire contract is to one person, it is exceeding 50 lakh rupees, though that would be, say 40 lakh rupees would be for the purpose of your carpentry work, which would again include your materials, and the balance 10 lakh rupees would be for his architect fees, which would otherwise be covered as a personal fees. Then it would be covered both together as since you are making the payment to one person. However, if the architect was different and your contract with the mistri or carpenter is separate, in that case, independently you will see whether it exceeds 50 lakh rupees or not. If it does not exceed 50 lakh rupees, as we have discussed in our example, no requirement of tax is to be made under section 194M. The next new provision which is inserted is on 194, and well, as such, this applicability will be only to the bank or cooperative society. However, the person who are hit are the SSCs or to whom we have been addressing or for whom we have been filing the return of income. Therefore, this clause becomes important for us to study. And that this clause says that if a person has made a payment and that person is a bank or a cooperative society or a post office, if they have made a payment exceeding 1 crore rupees during the financial year, they will be deducting or withholding tax at the rate of 2%. So if I am withdrawing cash from my bank account, and if during the year it exceeds 1 crore, then the bank will deduct 2%, which I will be taking a credit of my TDS, taxes that has been deducted. So how do I take the credit? That question I will come little later. But before that, let us have some more subsection or proviso which says that if the SSC has not filed his return of income for 3 assessment years, relevant to the assessment year till the filing of the time limit of 139(1) is over. In that case, if he has not filed the return for I would say that if you have not given to your bankers, even if you file the return of income, if you have not informed your bank or if you have not given the acknowledgements that you have filed the return of income, then the threshold limit of 1 crore will reduce to 20 lakh rupees. So if a person who is not filed the return of income for 3 years, then you need not take a threshold limit of 1 crore, it will be 20 lakh rupees. So in the year, if you have withdrawn more than 20 lakh rupees, then the taxes will be required to be deducted. And how it will be deducted? Up to rupees 1 crore, 2% only. If it exceeds 1 crore, then for such SSCs, it is going to be 5%. Now the question comes that, as I told you, you will be taking the tax credit, what has been deducted in the return of income. I understand that assuming it has also been reflected in your 26 AS. We all are aware that section 199, which is the enabling section or the relevant section for taking the tax credit, which says one of the condition is that it should be or the credit should be taken in the year in which the income is offered to tax. When I am withdrawing my money, my own money from my bank account, where is the element of any income in that? So if you ask me, first of all, how a tax is required to be deducted when there is no element of any income? Taxes is nothing but a mode of collecting tax on income. So TDS is nothing but a mode of collecting, like how we have advance tax, self-assessment tax, same way we have TDS. But here now they have extended to the provisions where there is no element of income. Of course, for TCS also they have done for LRS. Well, that not being a subject and it is not covered for our assessment year 2021. So I'm not touching upon this. But see the way the government approach has been. First, for 194A, they have inserted, though there is no element of any income. However, they have said that you require to deduct tax. I won't be surprised that if tomorrow an income tax officer says that, look, you have not offered any income in your return of income, qua this tax which has been deducted, how can I allow you a credit? It is a different thing that CPC blindly follows 26 AS and then they allow you this credit. But I am given to understand that there is a module or a schedule rather in your return of income which asks you this question, the TDS amount, qua the TDS amount, whether you have offered the income, and if you have offered, it is in which return of income, which year, assessment year this is offered. If it is not offered in this year, then you carry forward the TDS amount to the subsequent assessment year. Like how we professionals have been doing this. Say for our professional, just to explain it more clearly, for our professionals, the taxes are deducted in year 1, and that is on the basis of the provision. The client has deducted tax. However, in year 2, we have rendered the service of audit and we have received the payment, and therefore in year 2 we will be claiming that credit of TDS. But in year 1, because it is reflected in 26 AS, we do show that yes, this is the amount of TDS which is deducted. However, I have not offered any income and therefore I am not making any claim of TDS which requires to be carried forward to the subsequent year. This is the disclosure we make in the return of income in the respective TDS schedule. But when it comes to again 190 taxes deducted under section 194, and I have no clue how are you going to make this disclosure. But nevertheless, we would understand that just to take the credit, since the withdrawal has been made in this year, and for simplification purpose, because there is a conflict as far as provisions of 199 goes and 194A goes, we will say that yes, the income has been offered, though there is no income element, but since the withdrawal has been made in this respective financial year or assessment year, we will have to show this so that we can get a correct credit of TDS.
Sir, would you like to take a few questions, sir?
Yeah. Please. Yes, madam. Bharti madam, we can take up the question. If you could read the question.
Yeah.
You will have to take the trouble of reading the question.
So just a second, sir. Sir,
Sure.
in case of joint owners, the limit of 50 lakhs applies, sir, on individual owner basis or total consideration?
Yeah, okay. You are again referring to section 194IA, the threshold limit of this 50 lakhs, which says it applies to individual owner. Supposing there are more than one owner, joint owners are there. If in that case, you have to see individual single owner, the total agreement value is 70 lakh of rupees, and 50% are the two owners. Then the payment is also paid by both the owners, 35 each. In that case, this threshold limit will not be applicable to either of the owner.
And if the property is let out, but electrical service in the name of owner, if exceeds.
Yeah, this is a problem. So again, I'm coming to the proviso, which reads as has incurred expenditure of an amount which exceeds 1 lakh rupees. Now, your electricity meter would be in the name of the SSE. I have rented out that property. I have not paid. I have incurred the expense. In that case, you will not be covered by this proviso. So the person who has incurred the expenditure, he will be covered by this proviso, though the electricity meter would not be in his name. Here the word is has incurred expenditure. So you don't have to go with who is the owner of that electric meters. It goes qua the expenditure wise. I understand there may be a trigger. Say for example, today electricity meter is in the name of Bharti Madam. Now she has rented this premises to me, let out to me. I have paid this rent, payment of electricity meter, but would not be knowing because the electricity department has informed to the income tax authorities that look, this is the amount of electricity consumption which has been paid by Bharti Madam. So there would be a trigger if Bharti has not filed the return of income, then you may get a notice and you may have to mention that look, this is the reason and this is the X person who has occupied the premises and has paid the electricity consumption charges. So you need to keep a proper trail that that person is making the payment, and I will be informing to the department in case if I receive any inquiry. So the person who has occupied the property, the owner should make it very clear. Yeah, any
Thank you,
other
sir.
questions?
Yes, sir. Sir,
Okay.
section 194M also as section 194C.
No, 194M talks about the person who is not required to deduct tax, who is not required to carry his accounts to conduct audit. Therefore, the person who is already conducting audit, he is covered under 194. See, the person who is not in audit, only those persons are covered for 194M.
So in case SSC's gross receipts are 2 crores and file returns under section 44 AD of the Act,
I'll come to that.
M is applicable.
I have a separate slide on that. We will deal with that when we come to that. Yeah.
Okay, sir. Okay, sir. Is there any exception of new SSCs or startups under section 194N?
No, they have not made any exceptions to this. They have.
That all are the questions. So you may continue.
Now, yeah. Now coming to the Taxation Laws Amendment Act 2019. As in my initial remark, I said that I will have to not only cover the Finance Act 19 and Finance Act 20, I have Taxation Laws Amendment Act 19 also. And these are certain drastic changes which has been carried out by this Taxation Laws Amendment Act. And more, you will see the intention is to reduce the tax rates of the companies. That since the then Finance Minister Jaitley Saab had announced in the Parliament that within 5 years we will drastically reduce the tax rates of companies. To adhere to his commitment, these amendments have been carried out. Now, friends, if you see earlier, if the SSC is a corporate SSC, then basically the difference of your tax was for the domestic company a different tax rates and for a foreign company a different tax rates. Thereafter, the changes were made, and even if it is a domestic company, then the surcharge, applicability of the surcharge, the rates of the surcharge would be different. If it's a domestic company and the income is up to rupees 1 crore, no requirement of surcharge. If the income is between 1 crore and 10 crore, you need to pay 7% surcharge. If it's a foreign company, you need to pay 2% surcharge. And the then you need to pay surcharge at the rate of 12% if you're a domestic company and 5% if you're a foreign company. Thereafter, further they bifurcated by way of the turnover. If the turnover of the company in the preceding, I would say 2 years before that, you see, say for example, for assessment year 2021, if you have to see, then you will have to see the turnover of the company of financial year 17-18. If it was less than 400 crores, then you will have to pay tax at the rate of 25%. And if it is more than 400 crores during the financial year 17-18, you will be paying tax at the rate of 30%. So thereafter the bifurcation from surcharge, it came to the turnover. And then another section we have 115BA, capital BA, wherein certain conditions, if they are fulfilled for manufacturing domestic companies, then the tax rate is 25%. Now for assessment year 2021, we have two new sections, section 115B AA and 115B AB. Friends, let us understand what is BAA. If the conditions which are already given in the section are fulfilled, then your tax rate reduces. Now, what are those conditions? Number one, first of all, there is no restriction of the turnover, which was there earlier for 400 crores, more than 400 crores. So any company having any turnover can fall into this, can take the benefit of this if the conditions are satisfied. And the second condition is that the total income of the company shall be computed without claiming certain specified incentives. And the first one is additional depreciation that is available under section 32(1) small 2a. Now, additional depreciation, we all are aware that in case of the asset is used for the production purpose, then an additional depreciation of 25% is available. But if a person is taking benefit of that additional depreciation, he will not be covered for 115B AA. Similarly, if a company is taking a deduction under 10 AA, 32 AD, AB, etc., that company will not be covered. Further, if any deduction under section 80C to 80U, except 80JJA, 80LA and 80M, then also the company will not be eligible for this section. And from assessment year 2020-21, that 80, basically I can say 80G will be allowed, and the other deductions for chapter 6A would not be allowed except for 10JJA also. But since we are on assessment year 2021, 80G deduction will not be allowed because it talks about 80C to 80U. Furthermore, one condition, adjustment for brought forward losses on account of the above deductions that we have just discussed shall not be allowed to be set off. Similarly, if there is any unabsorbed depreciation, which is also on account of this additional depreciation, then also that unabsorbed depreciation will not be allowed. However, they have a proviso for that unabsorbed depreciation that you may readjust your opening WDV to the extent of the depreciation which has not been allowed. And further, the option for lower tax rate has to be exercised by filing form number 10 IC, and that has to be done before submitting your due date, before submission of your due date of the return of income. And next is, once the company has exercised this option, it cannot withdraw the option subsequently in any of the other previous years. So once you think that, look, yes, I am getting the benefit in assessment year 2021, I do not have any additional depreciation, I am not into the manufacturing area also, I do not take it under 35 A, B, C, etc. So let me take the benefit in assessment year 2021. But then you need to be sure that henceforth that company will not be, even if today is a trading concern, he is a service industry, tomorrow if he tries to expand his business by putting a manufacturing unit and the additional depreciation is much more higher, he will not be able to take the benefit of those once he has opted for this. Further, it says that provisions of MAT under 115 JB are not applicable if you have opted this option. Therefore, in case you have certain deductions which are or depreciation which is much more higher, if you calculate for your regular return of income as compared to your MAT provision, then in that case also it will not be a beneficial provision that a company would be adopting, and the adjustment of MAT credit brought forward will also not be available. In that case, instead of you paying, the company paying tax rate at the rate of 25 or 30% depending upon your turnover for financial year 17-18, the tax rate applicable to that company will be only 22%. However, the surcharge, which is 7% or 12% depending upon the total income, would be 10%. And of course, this higher education says there is the same 4% would be available. There is a greater challenge as far as this applicability, that is adjustment of brought forward losses and unabsorbed losses is concerned. They say that the provision says that the brought forward losses on account of this above provisions will not be allowed. Similarly, brought forward unabsorbed depreciation on account of the additional depreciation will not be allowed. The challenge which what the SSE or the tax practitioner that they would face will be, I have one figure of brought forward loss. That is, in the opening, I have one figure, say it is 5 crore of rupees. This 5 crore of rupees could be on account of various reasons. That could be my normal business loss. That could be on account of 35 AD, 35 CCC. That could be on account of my additional depreciation or my regular depreciation. Since this is coming out of my, say, last more than 7 years unabsorbed, losses 7 years, so the 8th year you are into. And if it is my unabsorbed depreciation, it could be more than 8 years also. That unabsorbed depreciation also could be because of my regular depreciation and because of my additional, that everything gets merged and it becomes one figure, and which is carried forward in your return of income or in your computation of income. The SSCB will have to start working backward and taking the benefit that, look, whatever depreciation has either already been adjusted is the depreciation which is the additional depreciation. Similarly, the losses which has been adjusted are the losses which are on account of the deductions under section 35D, AD or 35D, etc., etc. And the other business losses are which have been carried forward so that he can get the benefit of this set off in the subsequent years if he has to take, if he wants to fall into 115 BAA. So this is one challenge I wanted to bring to the notice of the participants over here. Coming to the second amendment, which has been a second section which has been inserted, again a benefit given to the domestic company which has set up and which has been registered on or after 1st October 2019 and has commenced manufacturing activity before 31st of March 23. But subject to the conditions, and the conditions are that this new undertaking should not be formed by way of splitting or reconstruction of an existing business. The company should not use old plant and machinery. The company should not be in a business of than a manufacturer, which has already been mentioned, which are the manufacturing. Certain deductions as described in 115 BAA shall not be allowed, and no adjustment of that brought forward losses qua those deductions will be allowed. Then a tax rate of 15% only will be charged to that company, plus the surcharge of 10%, and higher education cess of 4% will be charged. So the company who wants to fall into, first of all, it has to be a new company because it has to be registered after 1st October 19. And thereafter, you should see that it is not on account of any splitting or reconstruction or a new plant and machinery, which was the challenge what people have faced is or are facing is that, okay, I have already formed a company in the month of September 2019. I have not even ordered any plant and machinery by that time. After the formation of the company in the month of October, I started placing order, receiving the plant and machinery, all done after 1st October 19. Merely because my company is registered prior to 1st October, the entire activities have commenced afterwards. Whether the SSC, the company will not be allowed a benefit of this 15% merely because of that. Strict interpretation, the answer would be yes, since they have very clearly mentioned has been set up. I can understand, yes, the company was registered, but it is set up later on. That can be one interpretation. But if it is already registered before 110, the benefit would entirely go. Maybe the court may start taking the interpretation that, look, yes, it was registered, but the setting up, since the condition is set up and registered, it should be either one and not and should be read as, or in that case, the court may take a view and allow the benefit of 115 BAB, but that would be a risk that the SSC would be taking, whether the deduction will be allowed and the tax rate of 15% will only be applicable to that company. So broadly speaking, for the purpose of 115 BAA, an investor company, a service company, or a trading company, where the depreciation rates are not, where there is no additional depreciation, or where the depreciation rate as per the income tax is not very high as compared to the Companies Act, because the company will be following the rates of the Companies Act as per Schedule 3, then then they may fall into the provisions of the MAT. So the SSC will have to see whether the provisions as per MAT would be beneficial to the company, or the provision of the regular income tax by falling into BAA, whichever is beneficial will have to be taken. But if it's a mid-size or large-size manufacturing company where the additional depreciations are there the company may not be able to take the benefit of 115 BAA. Now that brings me to a provision which is on account of 44AB. 44AB, you all friends know, is a very old provision. Right from 2005, it has been there on the statute. And it has 5 limbs. Number 1, every person who is carrying on business, if his total turnover or gross receipt exceeds 1 crore, then he will have to get his accounts audited. That is limb number 1. That is, I would say, clause A. Clause B says if that person is carrying on the profession and if it exceeds 50 lakh of rupees. Clause C says if he is carrying on a business which is covered under 44AE, he needs to get, subject to certain, he needs to get his accounts audited. Clause D says carrying on the profession and if his turnover, if his gross receipt is less than 50 lakhs of rupees, and if he's offering say 50% of his gross receipt, he will be covered by 44ADA. If he's not offering 50%, he's get the clause E. He is carrying on a business, and if the provisions of subsection 4 of 44AD are applicable to him, and subsection 444AD, what does it say? We will refer it little later, since we need to understand what is presumptive taxation very clearly. So we will give some more time on that. However, just for a reference, I would say 44AD subsection 4 says that if you have not offered the income of 8% or 4%, and if your income is more than the maximum marginal rate, then you will be covered by clause E, and you will have to get your accounts audited. However, we have a proviso to clause E, which says that if you have offered the 8% or 6%, depending upon your cash transactions, if you have offered 6 or 8%, and if your income is not chargeable to, if you have offered 8 or 6%, then you will be covered by this proviso, but subject to that your turnover is not exceeding 2 crores. So if it exceeds 2 crore, you are not covered under 44A. But after the insertion of this proviso to clause A, the limit of 1 crore which increases to 5 crores subject to the condition which you are satisfying. And let us see what is the condition first. The condition is if aggregate of total amounts received, including amounts received for say turnover, sales, turnover, gross receipts during the previous year in cash does not exceed 5%. And B, aggregate of all payments made including all your expenditure in cash during previous year does not exceed 5%. Then if these two conditions are satisfied, again I will say both these conditions simultaneously, if they are satisfied, then your turnover of 1 crore should be read as 5 crores. And you do not have to get your accounts audited as per clause A. Again, I will repeat, as per clause A. So first, let us understand what are the two conditions, and then we go to the difference between clause A and proviso to clause E. So these two conditions, the first one, it says that amount received, including amount received for sales, turnover, etc. So if the sale of investment or sale of an asset, sales or amount received from proprietor or partner or cash withdrawn from bank, whether all this is to be taken together or whether all are to be included or certain are to be excluded. So let us understand one by one. First of all, whether interest or brokerage, sale of scrap, etc. are part of my receipts for the purpose of this proviso, the answer will be clear, yes. Second, sale of my investments or sale of my assets, which has nothing to do with my gross receipts and the turnover, are part of my receipts. The answer to that also will be clearly yes, because it says amount received, including amount received for so and so. Therefore, that means there is something other than your turnover and your gross receipts, which also you need to include for the purpose of this 5%. Third, receipts from partner or a proprietor. That is, if the concern, say, first let us take a partnership firm, certain partners have introduced cash in the firm, whether that needs to be considered for the purpose of this proviso. The answer to, as far as the partner is concerned, if the firm is receiving from a partner, both the SSCs being different, it needs to be included. Whether, if it is a, let us take, if it is a concern, if it is a proprietary concern, the proprietor has introduced 1 lakh of rupee in cash. Whether that 1 lakh of rupee will fall for this proviso, calculation of this proviso to A, in my view, if you strictly apply, the proprietor being a same person, the individual and the proprietary concern being the same person, it should not apply. However, when I come to the relevant question that has been asked in your income tax returns, that is ITR, they say capital contributed. They are not distinguishing between the partner and the proprietor. Therefore, one needs to take a call whether he should include proprietor because of this ITR's wording or not. But my view is that a proprietor should not, the capital contribution by a proprietor should not be included for the purpose of this calculation. Similarly, for the payments also, one needs to accordingly take a call. The fourth payment would be, the fourth I would consider is withdrawal from a bank. Bank as such is a different entity. You have made a withdrawal from the bank, or since we are on amount received, so once you are making the withdrawal from a bank, the partnership firm has withdrawn rupees 5 lakh from the bank. So is it to be considered? The answer to that would be, according to me, no, because this is your own money, which was in a different form, has now been converted into cash. That does not mean, I understand, asset was there, it is converted into cash, that is a sale of asset. Here there is nothing sale or anything. Here it is your own money which was in your current account has been withdrawn, and that should not fall part of your total turnover, total amount received by the firm. Similarly, if you're depositing or if the partner has withdrawn, the same analogy what you have adopted for your amount received will be accepted for your payments also. We all understand the purpose of introduction of this proviso is to reduce the cash transaction, and the SSCs who are able to do that, the legislature wants to give them the benefit that, okay, because your transactions are less than 5% of your total receipts and payments, or therefore you will not be required to get your accounts audited if you are less than 5 crore. This is the intention of the legislature. Now, coming to subsection 4 of section 44AB. First, again, I will read clause E. Friends, for the applicability of section 44AB, you need to fall into all subsections separately, independently. Say a person is carrying on a business, his turnover is 1 crore, would be on the provisos. Similarly, for B, if it's a profession, B, if he's into business, is C, if it is into profession, again, deemed 44ADA, then he's into D. It is not the case that if he's falling into D, whether he will fall into E also. That is not the case. So E, when we come to, it says that a person carrying on the business shall, if the provisions of subsection 4 of 44 AD are applicable in his case, and his income exceeds maximum amount which is not chargeable to tax, in that case, he is required to get his accounts audited. Provided, however, he will not be required to get his accounts audited if he declares the profit in accordance with subsection 1 of 44 AD, which says 8%, 6%, and his total turnover does not exceed 2 crores. Now let us read section 44, provisions of section 44 AD. This is the slide which I just which I'm referring to for the purpose of what is a sales turnover or gross receipt, which says that it includes capital account like capital contribution or loan taken. Loan taken, I can understand. Capital contribution and assets acquired. Capital contribution, I have my own reservation, as I have discussed with you, if it is a proprietor, whether to consider or not to consider. Coming to again our discussion on 44 AD. 44 AD subsection 1 says that if an eligible SSE is carrying on eligible business, and if he is offering 8%, I have not considered the amendment here for simplicity purpose that 8% should be read as 6% if his receipts are in cash, other than cash, until the due date of filing of the return of income, etc. I have not considered that for the purpose of simplicity. If he is offering 8%, then or as the case may be, a sum higher than the aforesaid sum claimed to have been earned, he shall be deemed to be that shall be deemed to be the profits and gains of inchargeable to tax. Therefore, as we saw in subsection 44 AD, it says that you are required to get your accounts audited. However, it says, the proviso says, if you have offered as per subsection 1 of 44 AD, your turnover is not 2 crore, you need not get your accounts audited. Now coming to subsection 4, which is also relevant because here clause E mentions that if you are covered by subsection 4 of 44 AD, then you will have to get your accounts audited. Now let us see what is subsection 4 of 44 AD, which says where an eligible SSE declares profit of any previous year in accordance with the provisions of this section, and it declares profit for any of the 5 assessment years relevant to the previous year succeeding such previous year, not in accordance with the provisions of subsection 1. So in the subsequent 5 years, if he is not declaring, say, 8%, he shall not be eligible to claim the benefit of subsection 1 for the next 5 assessment years. Therefore, very technically, if you ask me, an SSE who is not taking the benefit of subsection 1 of 44 AD in any of the earlier years, say he's a new SSE, let us understand, he's a new SSE, first time he's carrying on his business for assessment year 2021, his income is not as per subsection 1. His profit is less than 8%. Again, I will repeat that 8% will require to be substituted to 6% depending upon certain satisfaction of certain conditions. For simplicity purpose, I am just restricting my discussion to 8%. So if an SSC, first time SSC, carrying on a business for assessment year 2021, if he is not offered as per subsection 1, so he is not offered 8%, then he will fall into clause 4. But that clause 4 says, the subsection 4 says that for the succeeding 5 years, he will not be able to take the benefit of this. And section 44 AD clause E or subsection E says that he will have to get his accounts audited. Therefore, very technically, he will have to get his accounts audited for for the next 5 years, not for assessment year 2021. That is a technical reading, let me tell you. But unfortunately, the ITRs that we are filling up and the CPC does not agree with the interpretation that I have just sounded. The CPC, if you have shown a turnover of 1.5 crore and your profit is less than 8%, you did not get your accounts audited, they will trigger you that your return, what you have submitted, is a defective return. And you need to rectify as per the provisions of 139(10). Within 15 days, you have to get your accounts audited and file your return of income. In spite of making representation, in spite of flagging this issue that I'm not required to get my accounts audited, still they have not rectified this, and the SSC cannot afford to get his return remain as a defective return, because if he keeps as a defective return, it will presume that the SSC has not filed the return of income at all from ab initio, and the other consequences would arise. Say, for example, if there is any losses, brought forward losses are there, if the return of income is not filed, he will not be able to get the benefit of those carry forward losses in the subsequent years. Therefore, just merely to comply with this problem, the SSCs are getting their accounts audited. I have made myself very clear, very technically, you need not get your accounts audited in the financial year 2021. Let us take another example, that you are in assessment year 2021. For earlier assessment years, you have already taken the benefit of this subsection 144 AD. Say for year assessment year 18-19, you have taken the benefit of 44 AD 1, and you did not get your accounts audited. Year 2, you could not offer 8%. That is, year 2 is assessment year 19-20. You could not offer 8%, and therefore you fall into clause 4. And clause 4 says in the subsequent 5 assessment years, since you have already come out of this, or since you have already since you have not offered this 8% in assessment year 19-20, you will have to get your accounts audited, even if you are offering 8%. For the succeeding 5 years, you will have to do that, because you will no longer be able to take the benefit of subsection 4 for another block of 5 years. This is what subsection 4 says. We understand that this interpretation leads to an absolutely absurd situation. Now let us try to reconcile the after introduction of this proviso to subclause A. The proviso to subclause A, as we read down, as we understand, that look, I do not have, let us take an extreme example, I do not have any cash transactions. Therefore, the question of my satisfying clause A and B is fulfilled. Since I have fulfilled, so I should be covered under clause, I should be covered by this proviso, and the 1 crore limit should be extended to 5 crore limit. The example which I gave, that an SSE who has already opted for 44 AD in year 1, that is assessment year 18-19, in year 2, he could not, because his turnover was less, so he has come out of that in year 2. Therefore, for succeeding 5 years, he is falling into clause 4 of 44 AD. That is this clause, subsection 4 of 44 AD is falling into. So an SSE whose turnover is, so this SSE, supposing his turnover in assessment year is, let me tell, less than 1 crore. His turnover is only 90 lakh of rupees. And he is ready to offer 8%, but because of this subsection 4, which already he has hit into, he will be covered by subclause E, and he will have to get his accounts audited, even if he has no cash transactions at all. This is the absurdity that has been created. Therefore, a person who has offered, and let us take now an example just to understand it more clearly. Let us take an example that Mr. A, whose turnover is 4 crore, and he has a net profit of 1%. So he has offered an income of 4 lakh of rupees. And he will be, since he does not have any cash transaction, he will be covered. If he has never opted for 44 AD, he will be covered by this proviso, and because of this proviso, he will be allowed not to get his accounts audited, and he will not be hit by the subsection 4 of 44 AD, therefore not hit by clause E of 44 AB, and no accounts are required to be audited. So a person, example we have taken, person offering 4 crore, he has offered only 1%, still no accounts are required to be audited. Another person who has a turnover of say 1.5 crore, and he wants to offer 5%, less than 8%. In that case, he will be, since he has already he will be covered by clause E and not clause A. And if he is covered by clause E, the benefit of this 5 crore will not be applicable to him. I understand that this cannot be the intention of the amendment or the law. But the law is so badly framed because the proviso is not only qua E. This proviso is for the entire section 44 AD. And it reads like this. Again, I will read. Provided that this section shall not apply, not that this subclause E shall not apply. It says this section shall not apply to person who has been covered by 4481 and who has not offered 8% or 6% respectively. So an absurd situation is created. I do not know, one needs to test that what does the ITR or the CPC say. maybe CPC would understand the interpretation, what should be actually, and not rather what the legal interpretation is. If that is the case, it's a win-win situation, and the SSU may not get his accounts audited. But literal interpretation, this anomaly is there today on the statute, and the CBDT requires a clarification on this. Unless this clarification is there, one will have to get his accounts audited if he is covered by this proviso, which is a proviso to the section and not to subsection E. This is what I wanted to make it clear, and I think by this I am trying to cover the provisions of the deemed income also. Now I'm sure there would be questions. I'm sure there would be questions because of this absurd situation. Yeah, madam, we can take up those questions.
If in 1 year the SSA has not done any business and not offered under section 44 AD, whether he hit by section 40, say, subsection 4 of 44 AD?
No. In year one, if he has, year one is what? Is it assessment year 2021 or is it prior to that? Assuming, let us take both the example.
Sir,
Assuming,
whoever has asked the question can unmute themselves and ask, sir.
I have no issue. You have to take this call. You are the chairperson for this.
Yes, sir. We have given the option to unmute themselves, sir. Yes, sir.
Sir, it is not the first year. It is the middle of the year. In the third year, he has not done any business and not filed a return. And
okay. Then definitely he will not be hit by this proviso because he has never opted for 44 AD and still he doesn't want. But what is his turnover?
He didn't do any business in the third year at all, and he has not filed any return. In the fourth year,
yeah,
he started a business and he wants to file his return.
Yes, so, yeah, but what is his turnover?
1 crore.
Less than 1 crore, because don't tell
less
me.
Less than 1 crore.
Sorry?
Let us
understand it is less than 1 crore. And in that case, he will be hit by this proviso. Which proviso? He will be hit by the proviso to subsection to the section 44 AD. So if he is not able to offer 8% or 6%, he will have to get his accounts audited. This is the absurdity that I'm trying to bring out.
So another
either he offers, for the next 5 years. Either he offers 6% or 8%. If he's not able to offer,
my question is like this, sir. First 2 years, he has opted 44 AD and offered 8%.
Okay.
And in the third year, he has not done any business. He doesn't have any taxable income and he has not filed his return of income.
Then he's not hit by clause 4 of 44 AD.
In the fourth year,
clause 4. If you read again, let me make let me run through this question. Subsection 1 very clearly says that the last 3 lines shall be deemed to be the his total turnover of the business of previous year, or as the case may be, a sum higher than shall be deemed to be the profit. Sorry, subsection 4, not subsection 1. Subsection 4 says he declares profit of any of the 5 assessment years relevant to the previous year succeeding for such previous year, not in accordance with the provisions of subsection 1.
Yes.
So it talks about the succeeding 5 assessment years.
That's the reason if he doesn't do any business in the third year and he doesn't have any taxable income and not filed any return, under 44 AD does not arise at all.
Then he doesn't have to. Then then he will be directly covered by subsection E. He does not even have to apply the provision. See what does subsection E says. 44 AD E says, clause E says, are 44 AD are applicable to his case, and his income exceeds maximum amount which is not chargeable to tax. Now, the example that you are telling me, his income is not chargeable to tax.
That's fine. In the fourth
Therefore,
year,
he is not covered by E at all.
no, yes, sir, I accept it. In the fourth year, he started again, his business resumed, and his
Okay.
turnover is 1 crore,
Yeah.
and he wants to offer 8% now.
Huh.
Because of subsection 4 of 44 AD says, once you are not opted in the previous year 8%, you are not eligible to file in the succeeding 5 years. Because of not having any income, I have not filed my return in the third year. And fourth year again, I want to avail this 8%. Am I eligible or not? That
You
is
will
the
not
question.
be eligible. You have opted to come out. Once you have opted to come out for next 5 years, you will not be eligible.
Yeah, not by because of not
Taxable
opting
income.
8% by virtue of not having any income also.
I understand. But you have, unless you can show that my turnover was zero. Therefore, the question of applicable 44 AD doesn't come at all. Once it doesn't come, subsection 4 also doesn't come. But if you have a turnover and you are not able to offer, maybe if your turnover will be meager, 1 lakh rupees, then you are hit. Since you did not have any turnover in year 3, you can take the benefit that yes, I still continue to fall under subsection 1.
What I suggest is offer something 1 lakh and 8%, and we continue as covered by 44 AD.
Then no issue. Then definitely no issue. That's
Thank
a
you.
plan you should do then.
Thank you. Thank you.
Yeah, not at all.
Slightest extension to the practical case of mine for the assessment year 18-19, he followed 44 AD.
Yeah.
For the assessment year 19-20, because of the no business income and having income only from other sources,
Yeah.
he offered the income, and the question of following 44 AD doesn't arise in this particular case.
Correct.
And for the assessment year 2021, he got the business. Now that assessee wants to offer the income under 44 AD. So kindly,
That is the earlier question also, it was on the same line.
slight modification to Mr. Sharma's question is, he has filed the return for the assessment year 1920. It is not the case of his income is below taxable, which was subsection 4 hits. This is a case where income exceeds the taxable limit, but business income does not exist in the second year.
I appreciate. Yes, yes. So ultimately, since there is no turnover, the question of 44 AD would not be applicable. That is applicable only if he has any business income. Nothing, notwithstanding anything to the contrary contained in section 28 to 43C. So it is talking only for the business income. So that is not applicable to you that time. So you will be able to take the benefit in the year 3. And this more so will be now applicable because of this year, that is financial year ended 21. Many of them may not have any business. So what will be the situation for assessment year ending 22? The same questions will come again in 22, and not to few of them, to many of them. So that would, you can continue. My answer to that is yes, you can continue under the provisions of 44 AD in year 3. Yeah. I'm sorry, your voice is not audible. I can see your actions that you are trying to speak. Is something wrong my side? I don't know. Am I audible?
Yes, sir, you are audible. I also can't hear Bharti, sir.
Yeah, Mr. Bharti, sir, you are not audible. I'll switch off my video. Maybe it can be helpful if at all. I don't know. Mr. Bharti ji, you are not audible. I think he's not audible. Can we take some other person?
Yeah, yes,
Because
sir.
we otherwise you would be learning. Madam. It's already 6:25 and
I don't think this is a question. If there is no income chargeable to tax of zero in a particular year, does not debar the SSC to opt under section 44 AD in the 5 years block.
yeah,
It's a
yeah.
supplementary to my question. It's not a question. It just
Yeah,
you
it's
want
a
answer to my
answer, sir.
question.
Yeah.
You can
Sir, you
carry
may
on.
continue, sir. You may continue, sir.
All right. So now let us proceed ahead. The other amendments with that now we'll go a little faster. Due date, because this issue I wanted to cover in both the ways. The amendment to 44 AB as well as the deemed income clarification was required. There's a speculation, a due date of the filing return of all tax audit reports. I would say now that they have changed the due dates. All tax audit reports from October to they have made it November. So 1 month, the section 139(1) says date 1 month prior to the due date. Therefore, by this, what has happened is, 1 second, there is some, yeah. By this, and the reason behind is the government wants to come out with the pre-fill returns. So once you have uploaded your tax audit returns within the due date, that is 31st of October, the government presumes, I don't know to what extent they will be successful, that you will be given a pre-fill return. So any disallowances or etc. will be taken care in your pre-fill return. And thereafter, you need to submit your return of income. But as on date, I don't see there is any problem. One need not wait for the pre-fill return. Of course, if it's a company, the utility itself is not been announced, so we cannot file the company return. Barring that, if it's a business of a proprietor, he can today also get his accounts audited and file the return of income. He need not wait for the pre-fill return. But nevertheless, that has been now on the statute that there will be a different due date. The return of income due dates will be after 1 month of the tax audit. And the tax audits would be for all those sections which I have mentioned over here. Section 43(5), that is for the purpose of speculative transactions, they have considered commodity derivatives carried on at a recognized stock exchange. So that has been just a stock exchange. They have replaced the word, nothing much. 72AA, no major applicability to the participants. It's only for the banking companies and insurance companies. So amalgamation part, I would skip it. 119A, that is charters, taxpayers charter, which we all know that the citizens charter, which was since there on statute, not on statute, it was there since 2010. Many commitments were made by the department that as per the citizen charter, they should carry out their rectifications, give appeal effect, give refunds, etc. But since it did not have any, I would say, support or a statutory binding, now after the provision of section 119A, let us wait for the notification. The taxpayers charter has already been announced by our president, Prime Minister Modi Sahab, on 18th of August, when he announced of the faceless assessment and faceless appeals. Along with that, this taxpayers charter has also been unveiled. So we understand after the notification, something positive will still run up. Section 139(1), wherein the dates have been extended, that is one part. As far as the return of income, which is extended to 31st of October in the cases of a company, SSC whose accounts are required to be audited, and a partner of a firm whose accounts are required to be audited. Earlier, the word partner was used by, now the word partner has been replaced by the word working partners. Already there was a dispute that who is a working partner, the person who is drawing the is only a working partner, or a person who need not draw the remuneration still can be a working partner, and the person who is not getting any remuneration, whether the due date would be July or whether that would be September, earlier due dates I'm saying. So all disputes are now rest. They have said any person who is, any partner who is any partner who is in the firm which is under audit, he will have to get his, the due date will get extended as per the audit returns. And of course, the other extension which has been covered in my later slides because of the COVID-19 related notifications that we will refer to little later. A very small amendment to section 140, which also I would not cover the slide, which says, I don't know this slide. I will forward my presentation to Madam, Bharti Madam. So if anybody requires, you may still give it to them. 40A, 140A, 140, 156 and 191. Now this is related to ESOP and who are the persons who are in the startup. We all know that in startups, there is always a problem of liquidity crunch, and therefore the person who, to incentivize, they give their employees ESOP. However, once the ESOPs are given, the TDS is required to be deducted and the taxes are required to be paid accordingly. But here, if it is an ESOP case and if it is covered by section, the concern is covered by section 80 IAC, then they have a benefit that they, either of the three conditions, till either of the three conditions are satisfied, there would not be any requirement of taxes to be deducted. It's a welcome provision for the startups to boost the startups. 143, 3A and 3B. This is about the faceless assessment, the amendment which has come by Finance Act 2012. Thereafter, we saw to it that they have expanded to, from 1420, this scope was expanded to even ex parte, that is 144 assessment. And now, after the schemes have been announced, we have seen that except for only 2 cases, the entire faceless assessment has been expanded. 2 cases which is not covered are the central circle, wherever the raids have taken place, or if there was a survey and they have impounded some documents, then it will be transferred to central circle and not to the NEAC or faceless assessment. And the second one is that the TDS survey that they can carry out independently, those people are only excluded, barring that all are now covered by the faceless assessment. The DRP, I understand many of them would not be covered over here. This one section, section 270 capital AAD, this is a penalty for false entry in the books of account. Though this has been inserted by Finance Act 20 and with effect from 1420. But this being a penalty provision cannot be applied retrospectively. So we understand this will apply from assessment year 21-22. And now from assessment year 21-22, you have to be very cautious when you are having any false entry or you have omitted any entry. Let me give you by way of an example that if any person has taken bogus purchases or a long-term capital gain, bogus long-term capital gain, first of all, he will be hit by the provisions of specified section from 68 to 69C, wherein the tax rate under section 150 BBA will be 78%. And secondly, he will be paying a penalty of 100% of that amount under section 271 AAD. So one needs to be very careful now when you are dealing with any such scrupulous transactions. And this is certain amendments which have been carried out by way of an ordinance which has come on account of the COVID, wherein again the due dates which have been as per the law already extended, they have been further extended, and the common due dates are for all the return filing return of income, it is 30th of November. And for the tax audit, it is of 31st of October. I understand that yesterday we already have another bill which has been placed in the parliament, but I could not readily fully go through in depth. But nevertheless, I understand that that has nothing to do with our tax audit return filing extension or the due date of, though there were some messages going around that yes, there is an extension. But to me, there is no extension as of now for the purpose of filing our return of income as far as this new tax amendment bill has been placed yesterday in the parliament. Nevertheless, I understand the representations from all corners are being made, and even from chamber we will be doing it, that it requires an extension because the things are still not well settled on account of the COVID. With these words, I end up my presentation over here, and if you people have no issues, I definitely have no issues in taking up any questions. It's only on account of time factor that I have mentioned, and even I understand our Central Council member also has given some information, Mr. Prasanna. So maybe the call is to the chairperson now.
Thank you, sir. That was really a very good coverage within given time. That wonderful presentation, sir. Members will be waiting for your PPT to be circulated.
I'll do that.
Sir, I request our beloved Central Council member, D. Prasanna Kumar garu, to address our members.
Yeah. Sir, that is a very good presentation, Sanghvi. I was not visible, but I was sitting beside and hearing the entire conversation. And you know, that was a very interactive session. Even our members have also interacted very well. That's a very good session. I was also benefited out of the deliberation today. I had the occasion to hear best part of the presentation. Thank you very much, sir.
My pleasure. My pleasure.
Thank you. Yeah. Friends, you know, I just wanted to talk to you regarding some 2-3 issues which, you know, the chairperson was asking me to deliberate. As you know, the MEF is one thing which she wanted me to talk about. MEF normally we host it in the month of, you know, September or sometime in the August end also. This year there was a delay in hosting the MEF because some major changes were taking place with respect to the revamping the entire MEF form, whereby this unnecessary and unwanted information is getting deleted, and some information which is required for the purpose of empanelment other than bank audits, that is also being taken now. For example, there are some institutions, they want a panel of chartered accountants who can do internal audit or government audit, and you know, India's implementation, GST, and other indirect taxes, international taxes, and mutual funds and insurance. Like there's so many sectors they are asking for some empanelment from the institute. That is the reason we are trying to collect the information through the MEF this time. The second thing is that whatever the data that normally we fill is now taken from SSP directly. That is the reason why, in order to fill up the MEF and upload the data, so you should be registered with the SSP also. So most of the members are registered with the SSP. Still, there are some practicing chartered accountants who are not registered. I advise that unless you register, you will not be able to upload the MEF. So then coming to you know, what are the changes? So now hitherto, you know, the you know what you call the declaration, what you submit was to be signed by all the partners or the proprietor or the individual and send it physically to New Delhi office, or there are certain times where you have to do it with a digital signature. Both options were there. There are a lot of issues as with respect to sending the declaration because the postal delay, not properly captured on the head office, so on and so forth. Now we are done away with that one. So now in the new form, it is going to be OTP based. Those who are registered with the SSP, they'll get the OTP, and once you upload the OTP, that is the end of the completion or submission of the MEF. Like that, many changes are coming in this MEF. It was made a simplified form where the entire form can be filled up. For a bank audit process, within 10-15 minutes, you can fill up the form. And other things, of course, you need to spend a little time if you want a panel for other segments also. So, however, today only around 3 o'clock today, we have finally the advisory and the landing page of the MEF, because I am the convener for the MEF form hosting. So we have finalized that one. By likelihood, by Monday midnight, anytime. So it will be launched in the institute website. So these for information. So more information regarding certain issues with respect to MEF, and also with respect to the empanelment this year, and how it is going to be the allotment, how the eligibility is going to come vis-a-vis the Reserve Bank of India guidelines. So that is still under discussion stage. I will share with you how we are going to deal with that particular subject with respect to individuals and sole practitioners in the days to come. So nothing to worry. Things are in shape. We are in constant touch with the Reserve Bank of India, so that the present norms will be continued in future also. This is what I wanted to bring to your notice. And friends, as you know, the quality is the buzzword today. Quality. So, you see, in whatever the assignment you take, the mutual trust between the stakeholders and the chartered accountant, and the quality, what is expected by stakeholders and regulators is the buzzword today. So thereby, the FRRB, the Financial Reporting Standards Board, one minute, I'm just switching off my mobile. Yeah. So FRRB and the QRB, Quality Review Board, which is constituted by MCA through a gazette, whereby 5 central council members are also nominated into that particular QRB, and the NAFRA, which is applicable to all the listed companies, category 1 companies, and like that, many organizations are there, many institutes are there, which are going to review the quality. Similarly, as far as income tax is concerned, now we've got a tax audit review board, TQRB. So earlier, they used to review only tax audit reports certain listed companies. Now they want to expand the entire scope, and various categories of various levels of assessees are going to be under their scanner. So recently, TQRB also conducted a webinar where the commonly found mistakes were also deliberated in that particular meeting, so that we don't repeat such meetings in future. And we are going to, today only we had a meeting of Direct Taxes Committee around 2 o'clock today. So where we have decided to have one more meeting of that kind, so that in the season of this particular season of tax audit, so we'll be able to, tell the members where the improvements are required, where the shortcomings are there. And in line with the TQRB, that is Tax Audit Quality Review Board, along with the Direct Taxes Committee, they are coming out with a very beautiful booklet with a checklist required for the tax audit purposes. So that has already been completed. Various groups have been formed across the country, and we had one group constituted in Visakhapatnam also. So where 7 classes were given to Visakhapatnam group, which was led by CA A.V. Chalam, and another 16 chartered accountants. They contributed a lot. Within a short span of 3 to 4 days, the Visakhapatnam group has contributed a lot in preparing the checklist for the tax audit. So it is under vetting now before the Direct Taxes Committee. The moment that is over, they release the checklist. I think it's going to be very handy for conducting the tax audit this season. So similarly, we have the guidance note on tax audit also. It is also under revision by the Direct Taxes Committee. So we have already the advanced stage of preparation, and I think by the end of this month or first week of next month, so guidance note also will be there, because the guidance note which is there now is a very old one. Lot of updates needs to be required. So we are coming with a comprehensive guidance note, which will be useful to all of us. These are a few things I want to tell you. Then before I close, for the information of members, recently we had in the Central Council a discussion about the multidisciplinary partnerships. This has been discussed for the last more than 10 to 15 years. Multidisciplinary partnerships, and is as per the part of the regulations of chartered account regulation also is already there, that we can form multidisciplinary partnerships. But there was some resistance from our fraternity in some quarters, and there was some resistance from the other sister institutes also, that they don't want this to be implemented. The similar amendments in the Act took place in ICSI and the company secretaries and cost accounts also. They were also not interested. Recently, there's some information we got that Institute of Chartered Company Secretaries of India has in principle approved to go ahead with these multidisciplinary partnerships. So we started discussion in the council also, whereby is a time that we too wanted to go in line with the forming and permitting member. Though it is there in enactment, the operational guidelines are not been released. So now we have discussed and took a decision that we have to go with the operational guidelines and the modalities to be completed for the purpose of multidisciplinary partnerships. So whereby a chartered accountant can partner with a cost accountant, company secretaries, engineers, architects, and then advocates who are registered with the Bar Council of India, and actuaries. These are the categories of professionals with whom we can join. Model is under preparation. Very soon it may come up. And you know, there's a mixed response for this one. Some are welcoming, some are thinking that is not required. But anyway, this enacted. Is already the amendment took place long ago. There has been pressure from several quarters because that is there in the statute. You need to implement that one. This is one thing. With more details will come very soon. And similarly, you know, the networking guidelines, what was formed in the year 2011 or 12, it could not take off well. Hardly we have 100 networking firms in the country. Because of various, very issues that emanated after forming the networking. So yeah, it could not take off. Now the entire thing is getting revisited. So there is a group which are formed, and the entire that norms, whatever we discuss in the group, that has been placed before the council, and is advanced stage of discussion. Probably in the next council also, we are going to come up with new networking guidelines, whereby it will be operational, it will be very simple, and you know, it is certainly will be able to convince all the empaneling authorities, regulators like maybe SEBI, Reserve Bank of India, Control Audit General of India, and so on and so forth, that you know the networking should also be recognized for the purpose of taking the assignments. A very simplified format is going to come. So I think more details are sharing in the days to come. These are developments I just want to share with members of my fraternity from Visakhapatnam. So I think we are going to have one webinar next week. I think Vijayawada branch is organizing, where they are inviting, I think, all the chartered accountants from Andhra Pradesh also to discuss more about this MEF. What are the issues arising out of MEF, and also what are the things to be planned for the purpose of partnership, deletion, addition, subsequent addition, all those. There are many queries are there. I think this is not the right forum. In the next week when we have that meeting, I'll share more details about this one. So I thank once again for all of you to waiting till now, and I thank once again Sanghvi for an excellent presentation today. I thank Bharati and the rest of the managing committee members for doing many programs for disseminating knowledge to Visakhapatnam Chartered Accountants. Wish you all the best. Thank you very much.
Thank you, sir, for enlightening our members the things happening at the helm of affairs, sir. And taking this forum, I request all the members to please log into your SSP portal and see that the membership fee for this year is also paid by September 30th is the due date. So request all the members to do that also. Thank you, sir. Sir, one more question has come,
Yeah.
sir, for the speaker.
Yeah. Oh, speaker.
Sure.
Okay, okay.
Sir, has interest on a session 234A is not chargeable if tax payable is less than rupees 1 lakh.
Yeah. Okay, I did not take up I did not take up for want of time, but nevertheless it's a very right question. That if you see I did have it in the slide. Now section 234A, what they have said, the amendment that they have done. We all are aware that 234A talks about that in case of delayed return of income file, you are supposed to pay the interest. However, what did they say? That though the due date of filing the return is extended up to 30th of November, as per this ordinance of COVID ordinance, what we say, it is extended to 30th November. No relief has been provided for interest chargeable under 234A in case where self-assessment tax payable is in excess of 1 lakh. To that, again, they have made one exception. That is, if the resident, if the senior citizen who is a resident, and if he does not have any business income, then whatever taxes he is paying will be treated as an advance tax paid. So supposing the due date of the return of income of that resident senior citizen is 31st of July. In that case, original due date is 31st of July, though it is extended, and his tax liability of asset tax is more than 1 lakh of rupee. The amount of tax that he has paid will be treated as an advance tax. Therefore, automatically there would not be any interest liability on account of 234A. This is indirectly they are trying to say. But let us take an example of a person who is not a senior citizen, or who is a senior citizen but he has got a business income. He will not be covered by these exceptions what they have given. Therefore, in that case, he will have to pay interest under section 234A if his self-assessment tax liability is more than 1 lakh of rupee. However, I have brought down this case of CIT versus Pranav Roy. The Supreme Court has very clearly said that if the self-assessment tax paid before the due date of filing return of income, then that shall go to reduce the tax liability, and only after that, if there is anything to be paid, you will have to pay along with the interest. Therefore, they are not considering this Supreme Court decision, but in my view, this Supreme Court decision is a decision which they will have to consider. If I understand, when it goes to CPC, CPC will raise a demand, but if if it is cost effective, then you can prefer an appeal, and I'm very sure that there should not be any problem in getting the order in favor of you if applying this Supreme Court decision of Pranav Roy. Yeah, madam, any further questions?
Sir, any members, request members to unmute themselves if you are having any questions and ask the speaker. If there are no more questions, we shall wind up the session, sir.
I think we can, because there aren't any similar questions.
I think no more questions, sir.
Right, sir. Right now.
Thank you, sir. I request our Secretary Vasudeva Murthy Garu to propose vote of thanks for the session.
I think
Sir, Vasudeva
Sir,
Murthy Garu, we are not audible.
It's still not audible, but